There is a number hidden inside your Social Security check that nobody warned you about. It is not your benefit amount. It is not your cost of living adjustment. It is a quiet calculation the IRS runs the moment you start collecting, a number that decides whether the government takes 0%, 50%, or 85% of every check you receive. And here is what makes it terrifying. The trigger is not your salary. It is not your wealth. It is 3 specific accounts you almost certainly already own, accounts that turn your retirement into the most heavily taxed chapter of your entire financial life. Most retirees discover it only after the damage is done. By the time you understand the rule has already finished with you. The Social Security Administration does not call it a tax on your benefits. The IRS does not call it a penalty. They have a much softer phrase for it. They call it the combined income formula, and it has been sitting quietly inside the tax code since 1983, waiting for the inflation it was never indexed against to catch up with ordinary Americans, waiting for cost of living adjustments to push average retirees over thresholds that were designed to catch only the wealthy, waiting for a generation of workers to roll their lives into 401k plans and traditional IRAs, never realizing those accounts would one day stand between them and the full value of the benefits they spent 45 years earning. The trap was set decades ago. The 2026 tax season is when millions of Americans will finally step into it. And what most people are not seeing is the timing. The trap is closing right now in this specific window because 3 things have collided at once. The first is the 2.8% cost of living adjustment that took effect this January, lifting the average retired worker's monthly benefit from roughly $1,976 to $2,032. That is a small raise on paper. But every dollar of that raise pushes a portion of 75 million Americans deeper into the combined income formula, and not a single dollar of the thresholds that govern that formula has been adjusted to compensate. The second collision is the One Big Beautiful Bill Act, signed into law on July 4th of 2025, which the Social Security Administration emailed to millions of beneficiaries, describing it as if it had eliminated taxes on Social Security for nearly 90% of retirees. It did not. It introduced a temporary senior deduction that helps some, leaves others completely behind, and expires entirely in 2028. The third collision is the Congressional Budget Office's projection that the main Social Security Trust Fund will hit insolvency between late 2032 and early 2033, at which point a statutory 24% benefit cut becomes mandatory by law unless Congress intervenes. 3 forces, 1 moment. And the retirees in the middle of all of it are largely unaware. To understand exactly how the trap works, you have to understand the formula. The IRS does not simply look at your Social Security benefit and decide what fraction is taxable. It builds a separate parallel number first. It takes your adjusted gross income, then adds back any tax-exempt interest you earned that year, and then adds 1/2 of your total Social Security benefits. That sum is your combined income. That sum is the number that decides your fate. If you are single and that number stays below $25,000, none of your Social Security is federally taxable. If it slides between $25,000 and $34,000, up to 50% of your benefits become taxable. If it crosses $34,000, up to 85% of your benefits get pulled into your taxable income and stacked on top of everything else. For married couples filing jointly, the numbers shift slightly, but the trap is identical. $32,000 is the floor, $44,000 is the cliff. Cross that cliff and 85 cents of every Social Security dollar becomes ordinary taxable income. But here is where it gets worse. Those thresholds, $25,000 and $34,000 for singles, $32,000 and $44,000 for couples, have not been adjusted for inflation since they were written into law. Not once, not by a single dollar. When Congress passed those thresholds back in 1983, they were designed to capture only the wealthiest 10% of Social Security recipients. The math worked out cleanly. Most retirees earned modest amounts in retirement. The cost of living was a fraction of what it is now, and only the most affluent retirees with substantial pensions and large investment portfolios ever crossed those lines. Today, more than 40 years later, the average American retiree's combined income now blows past those same thresholds without breaking stride. A couple receiving roughly $3,700 a month in combined Social Security plus a modest pension or IRA distribution will almost certainly be over the line. The trap that was originally designed to catch 10% of retirees now catches roughly half of them. And the percentage rises every single year that the COLA pushes benefits higher while the thresholds stay frozen. Think about what that means. The same Congress that voted in 1983 to tax Social Security benefits as a one-time emergency measure to save the trust fund is now collecting that tax from working class and middle class retirees who were never the intended target. The reason it keeps working is silent inertia. Updating the thresholds would require Congress to vote on it, and no member of Congress wants to be the politician who refuses to update them, because that means raising taxes on seniors. But no member of Congress wants to actually update them either, because that means losing tens of billions in revenue that currently flows back into the trust fund itself. So nothing moves, the trap stays armed. And every new retiree who steps into 2026 walks straight into it. Now we get to the part nobody explains until it is too late. 3 specific accounts inside your retirement portfolio are the engine that drives your combined income upward. Not your house, not your car, not even your savings account in most cases, 3 accounts. And if you do not understand how each one feeds the formula, you cannot escape what the formula does to your benefits. The first account is the traditional 401k. The very same account that millions of Americans have been told for 40 years is the cornerstone of a secure retirement. The same account your employer matched. The same account you maxed out every year. The same account your financial advisor told you to keep contributing to, because the tax deduction now would save you money later. Here is the part they often did not explain. The phrase tax deferred is not a synonym for tax free. It is a synonym for taxes you have not paid yet. And every single dollar you withdraw from a traditional 401k in retirement counts as ordinary income on your federal return. That ordinary income flows directly into your adjusted gross income. Your adjusted gross income is the first input to the combined income formula. So when you pull $30,000 out of your traditional 401k to cover living expenses, you have not just created a $30,000 tax bill on the withdrawal itself. You have also potentially pulled tens of thousands of dollars of your Social Security benefits into the taxable pile alongside it. The IRS taxes the withdrawal. Then it uses the withdrawal to tax your benefit. The same dollar punishes you twice, and this is where everything changes. Because the worst version of this trap is not when retirees withdraw too much from their 401k all at once. It is when they wait too long to withdraw anything at all. Required minimum distributions begin at age 73 for most current retirees under the Secure 2.0 Act, and shift to age 75 for those born in 1960 or later. If you spend your 60s and your early 70s leaving your traditional 401k untouched while you live off Social Security and other sources, that account compounds. It grows. It swells. And then, the year you hit 73 or 75, the IRS forces you to start withdrawing a percentage of it whether you want to or not. By then, the account may be so large that a single year's required minimum distribution can vault you straight from the lower tier of the combined income formula into the 85% cliff. The very accounts that were supposed to give you flexibility in retirement become the accounts that strip your benefits of their value precisely when you can least afford it. The second account is the traditional IRA, and the trap here is even more subtle because the traditional IRA carries every weakness of the 401k, plus a few of its own. Like the 401k, every withdrawal counts as ordinary income. Like the 401k, it triggers required minimum distributions starting at 73 or 75, depending on your birth year. But unlike the 401k, the traditional IRA is often held by retirees who rolled over old 401k balances from previous employers, consolidated retirement accounts, or inherited tax-deferred money from deceased family members. That means the traditional IRA balance for many 60-somethings is the single largest pre-tax asset on their personal balance sheet, and the IRS knows it. Every projection model the Treasury runs assumes that this enormous pool of untaxed wealth, currently sitting inside traditional IRAs across America, will eventually be forced into taxable distributions through the RMD mechanism. The traditional IRA, in other words, is not your retirement account. It is the government's largest unpaid invoice. Here is the real story. The reason the traditional IRA is so dangerous in 2026 specifically is that the OBBBA legislation that just passed has now made the existing federal tax brackets permanent. There's no longer a planned bracket increase looming over taxpayers. The previous narrative for years was that retirees should convert their traditional IRA balances into Roth balances before brackets reset higher in 2026. Now, those brackets are not resetting. The 22% bracket extends to $105,700 for single filers and $211,400 for joint filers. The 24% bracket goes higher still. That sounds like good news, but it actually changes the strategic calculation in a way most retirees have not adjusted for. Because tax brackets are now permanent, the case for waiting on Roth conversions has weakened, while the case for executing them during the specific window between retirement and Social Security claiming has strengthened dramatically. Anyone who keeps their traditional IRA balance large and intact while drawing Social Security is volunteering year after year to maximize the 85% inclusion of their benefits. They are walking into the trap and locking the door behind themselves. The third account is the one that catches everyone by surprise. Tax-exempt municipal bonds. Read that again carefully. The account's marketed to retirees specifically because their interest income is exempt from federal taxation. The account's advertised in glossy brochures with the words tax-free in bold print. The account's your broker recommended because, in their words, the interest income would not show up on your federal return. Technically, all of that is true. The interest from qualified municipal bonds is exempt from federal income tax. But the combined income formula does not care about federal income tax. It has its own rules. And the Social Security worksheet that determines how much of your benefit is taxable specifically pulls tax-exempt interest back into the calculation. Adjusted gross income plus tax-exempt interest plus half of Social Security benefits. The phrase tax-exempt interest is right there in the formula. The very thing you bought to keep interest out of your taxable income is being used by the IRS to determine that more of your Social Security should be in your taxable income. This is not chaos. This is design. Think about what that means for the average retiree. A couple in their early 60s looks at the bond market, sees yields on municipal bonds, and decides to park a significant portion of their nest egg there. They believe they are being conservative. They believe they are being tax smart. The interest comes in year after year and never shows up as taxable income. They feel safe. Then they start Social Security at 67. And suddenly, the same municipal bond interest that did not cost them a penny in federal income tax is silently inflating their combined income number and dragging 85% of their Social Security check into the taxable pile. The tax they thought they were avoiding has been redirected into a far larger tax they never saw coming. And by the time they understand it, the bond portfolio is already constructed, the income stream is already in motion, and unwinding it triggers either capital gains, transaction costs, or both. According to financial planners who specialize in retirement tax strategy, this is the single most misunderstood interaction in the entire tax code for seniors. People can recite the rules of Roth IRAs by memory. They can quote the contribution limits for HSAs. They can explain the difference between long-term and short-term capital gains. But almost no one can correctly explain how municipal bond interest interacts with the Social Security taxation formula. That gap in knowledge is precisely where the wealth gets quietly extracted, one tax season at a time. And this is where the real strategy emerges. Because if those are the three accounts that drive the trap, then the question becomes not how to live with the trap, but how to drain those accounts strategically before Social Security even begins. The window for doing this is narrow. It exists in the years between the moment you stop working and the moment you start drawing benefits. For early retirees, that window can be 5 to 10 years long. For those who retire later, it might be only 2 or 3. But it is the most powerful tax planning window in the entire retirement timeline. And most Americans waste it by either claiming Social Security too early or by leaving their traditional retirement accounts untouched. Both mistakes carry the same cost. Both mistakes hand the IRS a much larger share of your retirement income than necessary. Here is what informed sources inside the financial planning industry have been quietly advising affluent clients to do for years. During those pre-Social Security years, when your earned income drops to zero and your adjusted gross income is at its lowest point in decades, that is the moment to begin systematically converting traditional 401k and traditional IRA balances into Roth IRA balances. The conversion itself triggers tax, yes, but the tax is paid at your lowest possible rate, before Social Security is added to the income mix, before required minimum distributions force your hand, and before brackets potentially shift again in future legislative cycles. Once the money is inside a Roth, the entire dynamic flips. Roth withdrawals in retirement are not taxable. They do not count as ordinary income. They do not increase your adjusted gross income. And critically, they do not enter the combined income formula at all. A retiree who has successfully moved a significant portion of their traditional balances into Roth balances before claiming Social Security can structure their withdrawals to keep their combined income artificially low for the rest of their life. They can hold their benefits below the 85% cliff. In many cases, they can keep them below the 50% threshold entirely. And here is where the math gets brutal in favor of those who plan correctly. For a married couple filing jointly in 2026, the base standard deduction has risen to $31,500 under the OBBA. Each spouse, age 65 and older, adds an additional $1,650 on top of that. Then the temporary senior bonus deduction created by the OBBBA stacks another $6,000 per qualifying spouse, capped at $12,000 for couples where both partners are at least 65, available only through tax year 2028, and only for households whose modified adjusted gross income stays below $150,000. Stack those numbers together. A married couple in their late 60s can shield close to $50,000 of income from federal tax before owing a single dollar in 2026. If their Social Security never crosses the combined income thresholds, and their other retirement withdrawals come from Roth accounts that do not feed the formula, they can structure a retirement that legally pays close to zero in federal income tax while still spending $60,000, $70,000, even $80,000 a year. But that strategy only works if the 3 trap accounts have been drained or converted before Social Security starts. Wait too long, and the senior bonus deduction phases out as your modified adjusted gross income climbs past $150,000. Wait longer, and required minimum distributions force the trap accounts to start emptying themselves at the worst possible moment. The window is real, the window is closing, and the window is what separates retirees who keep their full Social Security benefit from retirees who quietly hand 15, 20, or 30% of it back to the IRS every year for the rest of their lives. Now we get to the part of the story that almost no commentator is connecting properly. The Social Security Trust Fund itself. According to the most recent Congressional Budget Office projections, the Old Age and Survivors Insurance Trust Fund will be exhausted somewhere in the fourth quarter of 2032 or the first quarter of 2033. The new senior bonus deduction created by the OBBBA actually accelerates that date by approximately 3 months because the lower federal tax revenue from the deduction reduces the amount that flows back into the trust fund through the taxation of benefits. When that fund hits zero, the law as currently written triggers an automatic across-the-board benefit cut of approximately 24%. Not means-tested, not gradual. 24% off every check for every recipient. The only way to avoid it is for Congress to pass legislation between now and then to either raise revenue, cut benefits in a different way, or restructure the program entirely. None of those options are politically easy. All of them are being discussed in Washington right now, including a recent proposal from the Committee for a Responsible Federal Budget to cap total household Social Security benefits at $100,000 annually for retirees claiming at the normal retirement age. And this is where everything changes, because if your benefit is going to be reduced anyway, either by legislation or by automatic trust fund cuts, then every dollar of taxation on the remaining benefit becomes that much more devastating. The retirees who are bleeding 85% of their checks into taxable income in 2026 are setting themselves up for a double hit. First, the tax extraction. Then, potentially, the benefit reduction. The compounded effect on a household budget over a 20-year retirement is not small. Financial planning models that simulate both scenarios suggest that a married couple drawing average Social Security benefits with traditional retirement accounts feeding the combined income formula could see their effective lifetime Social Security income reduced by anywhere from 20 to 40%, compared to a couple who executed Roth conversions during the pre-claiming window. Read that again. 20 to 40% of your Social Security income potentially erased over the course of your retirement simply because of how 3 specific accounts were structured before you started collecting benefits. What most people are not seeing is that this problem compounds with geography. Federal taxation of Social Security is just one layer. State taxation is another. As of 2026, 41 states plus the District of Columbia do not tax Social Security benefits at all, but 9 states still do, to varying degrees. Some of those states use the federal combined income formula as their starting point. Some have their own thresholds. Some offer partial exemptions. If you happen to live in one of those 9 states and you do not understand the local rules, you could be paying federal tax on 85% of your benefits and state tax on a different percentage at the same time. That is not a hypothetical. A lot is the actual financial situation of millions of American retirees who chose to stay near their adult children, near their grandchildren, or simply in the home they have lived in for 40 years without realizing that their zip code was costing them thousands of dollars a year in additional retirement taxation. The maximum Social Security benefit for a worker retiring at full retirement age in 2026 is approximately $52,450 annually, or roughly $4,370 a month. That number rises slightly each year. It also gets taxed more aggressively each year in real terms because the thresholds that govern its taxation do not move. A retiree who claimed at full retirement age in 1983, the year the combined income formula was created, would have been comfortably below the threshold with a benefit equal to the maximum of that era. A retiree claiming the equivalent maximum benefit today crosses the cliff before any other income is even counted. The system, by simple inertia, has been transformed from a tax on the wealthiest retirees into a tax on virtually anyone earning the maximum benefit Social Security legally allows, and this is where the real story breaks open. The Social Security Administration, in the months after the OBBBA passed, sent out a mass email to beneficiaries that suggested the new law had effectively eliminated taxation of Social Security for the majority of recipients. The phrasing was technically defensible. The reality on the ground was something different. The senior bonus deduction does provide meaningful relief for households whose modified adjusted gross income stays below $150,000. But the deduction phases out completely above $250,000 for joint filers, leaves the underlying 85% inclusion formula completely untouched, and expires entirely at the end of 2028. After 2028, unless Congress extends it, the deduction vanishes, the formula remains, and the retirees who structured their accounts around the temporary relief will find themselves exposed to the original trap with no safety net. This is the strategic puzzle facing every American approaching retirement right now. The temporary deduction provides cover for the next 2 tax years. The permanent formula behind it has not changed. The trust fund is approaching insolvency. The political environment that would be required to fix any of these structural problems remains gridlocked. And the only lever that any individual retiree can actually pull with their own hands in their own portfolio is the strategic drawdown and conversion of the 3 trap accounts before Social Security begins. Here is what informed sources within the wealth management industry have been emphasizing repeatedly in 2026. The retirees who will emerge from the next decade with their benefits intact are the ones who treat the pre-Social Security window as the single most important tax planning event of their lives. They retire from full-time work in their early 60s. They live deliberately off taxable brokerage assets and cash reserves during the gap years. They execute methodical Roth conversions from their traditional 401k and traditional IRA balances, filling the lower brackets each year without spilling into the higher ones, watching the IRA Medicare premium thresholds carefully so they do not accidentally trigger surcharges that begin at $109,000 of modified adjusted gross income for single filers and $218,000 for joint filers in 2026. They restructure or unwind municipal bond positions that were quietly inflating their combined income calculation. And by the time they finally claim Social Security at 67 or 70, the 3 trap accounts have been substantially neutralized. The combined income formula still runs, but it runs on a much smaller number. And the 85% inclusion that destroys other retirees never reaches them. The retirees who do not plan this way often discover the problem only after the first tax return that includes both Social Security and significant traditional account withdrawals. The shock is real. The bill is real. And the structural fix at that point becomes much harder because Roth conversions executed while Social Security is already being collected drag even more of the benefit into taxable territory. The window is closed. The trap is shut. The retiree spends the rest of their life paying tax on the very benefits they spent 45 years earning, all because 3 specific accounts were left intact at the wrong moment. There is one more layer to this that almost nobody outside the financial planning industry is talking about: the earnings test that applies to Social Security beneficiaries who claim before reaching full retirement age. In 2026, if you claim benefits early and continue to earn wages, the Social Security Administration will deduct $1 from your benefit for every $2 you earn above $24,480. In the year you actually reach full retirement age, the deduction softens to $1 for every $3 above $65,160. Once you reach full retirement age, the test disappears entirely. The earnings test only applies to earned income from wages or self-employment, not to distributions from retirement accounts. This creates yet another strategic layer. Retirees who continue to work part-time while claiming benefits early face a different set of trade-offs than those who fully retire. Those who do not understand the interaction between the earnings test and the combined income formula can end up triggering both penalties simultaneously, losing benefits to the earnings test on one side while also taxing the remaining benefits on the other. What this all adds up to is a retirement landscape in 2026 that has more moving parts than at any point in the history of Social Security. The COLA is rising, the thresholds are frozen, the trust fund is bleeding, the temporary senior deduction is masking the underlying problem for 2 more years. The 3 trap accounts are doing their work quietly in the background of millions of retirement portfolios. The 401k, accounts that did not exist in significant numbers when the formula was passed, are now the dominant retirement vehicle for working Americans. The traditional IRAs that were a niche product in 1983 now hold trillions of dollars in untaxed wealth. The municipal bond market, designed to fund local infrastructure, has become a major holding for retirees, specifically because of the tax exemption that the combined income formula then reverses. Every piece of the modern retirement landscape was bolted on top of a 1983 tax structure that nobody bothered to modernize. And the cost of that institutional neglect lands every April on the kitchen tables of American retirees. So the question that hangs over every retirement decision being made right now is whether the next 10 years will see meaningful reform of any of this, or whether the trap will simply keep tightening as inflation grinds the unindexed thresholds into irrelevance. Congress has known about this problem for decades. The Treasury has modeled the impact extensively. The Social Security Administration's actuaries publish updated projections every single year. The information is not hidden. The political will to address it simply does not exist. And in the absence of structural reform, the burden of navigating the trap falls entirely on individual retirees and the financial planners they hire, or in most cases, the financial planners they never hire. The window of opportunity for those still approaching retirement remains open, but it shrinks every month. Roth conversions executed in 2026 will pay tax at brackets that are now permanent under the OBBBA. The temporary senior bonus deduction is available through 2028. The trust fund is solvent for approximately 7 more years. Every month that passes brings the system closer to a forced confrontation between political reality and actuarial reality. When that confrontation happens, the rules will likely change. Whether they change in favor of retirees or against them is impossible to predict. But the retirees who have already moved their 3 trap accounts into Roth structures, who have already drained the traditional balances during the pre-Social Security window, who have already restructured their municipal bond holdings to minimize the combined income drag, will be the retirees who are best positioned regardless of which way the politics breaks. They will have insulated themselves from the worst version of the trap before the trap becomes everyone's problem. The retirees who do nothing, who follow the conventional advice of leaving tax-deferred accounts alone for as long as possible, who claim Social Security at 62 without considering the interaction with their other income sources, who hold municipal bonds because somebody told them the interest was tax-free, are walking into a system that will quietly extract a significant portion of their retirement security. The system will not warn them. The Social Security Administration will not warn them. Their bank will not warn them. Their brokerage statement will not warn them. The combined income formula will simply run year after year until they look at their tax return and realize that the 85% number applies to them. So the real question, the one that should be keeping every soon-to-be retiree awake at night, is not whether the rules are fair. The rules are what they are. The question is whether you have time to act before the trap closes around your own portfolio. Have you mapped the 3 accounts that are silently feeding your combined income calculation? Do you know how large your required minimum distributions will be when they begin? Have you modeled what happens when Social Security is layered on top of your existing income sources? Have you executed even one Roth conversion this calendar year? Is there a clear strategy in place, or are you simply hoping that the temporary senior deduction will be enough to protect you when it expires in 2028? Because hope is not a strategy. The IRS is not waiting for you to figure this out. The trust fund insolvency is not waiting for you. The thresholds are not moving. The only variable in the entire equation that you actually control is the structure of your 3 trap accounts, and the window for restructuring them is open right now in a way that may not be true again for the rest of your life. What happens next will be decided not in Washington, but in millions of individual decisions being made this year by retirees who either understand the trap or do not. The ones who understand it will act. The ones who do not will eventually wonder, sometime in the next decade, why their Social Security check feels so much smaller than they were promised. And by then, the rules of the game will already have moved on without them. The trap is set, the formula is running, the thresholds are frozen, the trust fund is bleeding, and the only question that matters now is whether you will move first or whether you will let the system move first against you.